Well, holy smokes, everyone. It has finally happened. The yield curve in the bond market is signaling recession and it is finally inverted. This is something on the channel we've been watching very closely, and a yield curve inversion has predicted many, but not all recessions. So in today's video, we're going to go over, is a recession really coming, and how will this affect the stock market and the cryptocurrency market? Because how the Federal Reserve, bond traders, and investors play this market is going to be pivotal. Now, if we get into the content, if you can hit the like and subscribe button, that'll be great. Also, Moomoo this month is doing an exclusive offer. We can get 3 free stocks when you deposit any amount. This is the most generous offer among all brokerages, so check the link in the description and pin comment. Okay, everybody, let's get into it. Look at this, everyone. A recession warning. Part of the US yield curve inverts for the first time since 2006. So this is something that doesn't happen often, everyone, so we definitely need to pay attention. A flatter yield curves are momentum play for now, TD Security says. Spread between the 5 and 10-year yields have already inverted. And I don't know about you, but what I've been seeing since the Federal Reserve has all of a sudden stopped buying US Treasuries and bonds, it's looking like the bond market is broken right now, and bonds are getting absolutely hammered. Listen to this. Treasury slumped anew to send widely watched part of the US yield curve to its first inversion in 16 years. The curve is flattening as investors bet the Federal Reserve will tighten policy rapidly enough to risk a sustained slowdown in growth. And we're definitely starting to see this, people. We're starting to see US consumer confidence is slowing, and we're starting to see spending is slowing. We'll have to see if it slows enough to bring the economy into recession. But listen to this, everyone. This is huge. The US 5 yield has climbed 9 basis points to 2.6%, rising above those on the 30-year bond. Shorter maturities have been selling off faster than longer date peers this year as investors ratchet up expectations the Fed will hike rates to combat inflation. Now, the spread between the 5 and 10 years already inverted earlier this month. So I'll just bring up the chart here, people. We can see the historic spread. We can see here in 2010, 11, 12, there was a pretty big spread, but now we can see it has finally inverted, just like what happened in 2005 and 6, right before the 2008 global financial crisis. So I don't know about you, but I'm starting to get a lot of deja vu with things that are happening now, right before what happened in 2008. Now, things definitely aren't as bad as 2008 right now, but it doesn't mean we can't get there in a couple of years. So you're probably wondering, okay, what is causing this? Well, what has caused this is since the Federal Reserve has come out and said they're going to lift interest rates by 2% this year. Now, more recently, just a week ago, Jerome Powell came out and said, look, okay, we may be behind the curve on inflation here, but don't worry, we're really going to bring down inflation. We're going to lift interest rates possibly by 0.5 percentage point, 0.5% in our May meeting. But I think what the markets are starting to see is Jerome Powell is just all talk. He's trying to talk down the markets. He's trying to use forward guidance, and he's hoping that he can engineer a soft landing, which so far it's looking like he may. But again, people, I don't think we're going to see really any pain in the economy till once interest rates start going above 2%. It's kind of like that guy in a fight where he has his friends holding me back and he's yelling, I'm going to get you. I'll get you. I'll knock you out. Yeah, I'll take you down. But when his friends released him and said, okay, go do it, he's going like, you know what, maybe not. But listen to this. Powell also pushed back against concern that inverted yield curve would signal the economy is headed for recession, saying that it made more sense to focus on the shorter end where curves remain steep. Again, people, this is what all central banks do. They're going to have to continue to talk up the economy, talk up the markets, because their words have the power to either lift us out of recession or take us into recession, because we're seeing that the algorithm trade on pretty much everything that they say, and a lot of retail investors trade based on the words they say as well. But okay, what are some other indicators that are telling us that a recession may be coming? And then I'll get into how this may actually be bullish for stocks and cryptocurrencies in a moment. So listen to what's happening now, everyone. US consumer sentiment remains a decade low on inflation and war. The University of Michigan gauge dropped slightly from early March, and buying attitudes stay at record lows amid price pressures. And this is exactly what's to be expected, everyone. Once people's bills go up, once they have to put all their money on food, utilities, and housing costs, well, simply, they're not going to have any money left over to spend on discretionary items like technology, designer clothing, eating out, and luxuries. So listen to this. The University of Michigan Sentiment Index dropped to 59.4 from 59.7 earlier in the month. And I bring up the chart here where we can see we're getting close to 2011 levels where there was fears of a double dip recession. But also what we have been seeing is a 10-year US Treasury yield absolutely skyrocket now that the Federal Reserve is no longer buying. So if we look here yesterday, it actually hit a peak of around 2.55%. That is absolutely crazy, everyone, because only a few months ago, it was at 1.3%. Now, what my thoughts are and my expectations in the bond market is, this is just my opinion, there's no guarantees, but if we look at history, what happened when the Federal Reserve lifted interest rates to 2.25% in 2018, the 10-year hit around 3%. So that's the rate I'm thinking that the US Treasury will go to but I'm definitely not going to want to invest in bonds when they're only giving me a 3% yield. And it's not looking bullish for bonds either, with the Federal Reserve about to start dumping their $9 trillion balance sheet. So okay, it's looking more likely than not that the US economy is going to enter a recession. Now the question is it going to be a deep recession or just a technical recession where maybe we see 2 consecutive quarters of negative GDP between 0.1% and 0.5%? And will this trigger a stock market crash, cryptocurrency crash, and housing market crash? Well, everyone, it could actually do the opposite for stocks and cryptocurrencies. And let me explain. Because what we've seen happen over the past 3 months since December, when the Federal Reserve announced it is going to start aggressively hiking interest rates, we saw the Nasdaq fall over 20% and we saw the S&P fall about 15%. So the stock market has already priced in the Federal Reserve lifting interest rates to 2%. Now what you also have to know is the markets are not the economy. They rely on stimulus and low interest rates. Now, what could happen is once the economy enters an official recession, we could have the Federal Reserve all of a sudden U-turn and flip, like what they did in 2018, where the market and economy and housing market started to drop. The Federal Reserve all of a sudden flipped, and then they dropped interest rates from 2% all the way back down to 1%. And the markets loved this, and they went from their 20% decline all the way back up to new all-time highs. And so what this means is if the Federal Reserve is going to choose between fighting inflation and going into recession, I think it's come quite clear right now what they're going to do. They're going to choose to save the economy and let inflation run hot rather than actually fighting inflation. So I do think a recession is still likely, and if we can avoid a deep recession or a depression and inflation continues to run hot, I think we're going to continue to see the markets melt up. Now, the only market that hasn't had a correction yet is the housing market. So if interest rates do go to 2% and we start to see mortgage rates go to 6%, then I think we will start to see some slight falls in the housing market, but I don't think anything more than 10 or 15%. And the reason I say 10 or 15% is because every 1% increase in interest rates, a home buyer's buying power or the borrowing power gets reduced by about 10%. So everyone, I'm not panicking. I'm still just dollar cost averaging into the markets, and I'm now increasing my cash position into the markets. I'm now deploying up to 30% of my cash in the markets, because even though we've had a recent rally over the past week or two, stocks are still at a discount compared to their all-time highs, and the same with cryptocurrency. And if they fall further, which I definitely hope they do because I have more cash on the sidelines than actually in the markets, well then I'll come in and buy up the mega dip. But everyone, this is just my thoughts and opinions. Anything could happen. But what do you think? Let me know. Now, for all my loyal viewers and subscribers still watching, you're awesome. Again, if you want to get 3 free stocks with Moomoo when you deposit any amount, which is pretty much free money, I'll put a link in the description and a pinned comment. Thanks for watching. I'll see you all in the next video.